going to ask, can everybody hear me?
Loud and clear.
There we go. Cool. Perfect. Hey, so first of all, thanks for tuning in. We've got a presentation here shortly from Franklin Templeton. I'll make that introduction here in a few minutes. But prior to that, wanted to go over a few things as usual. One is just to remind everybody to put January 17th on your calendar. I think we've sent out a save the date. We'll have more details to follow on that. But that will be the day of the regional meeting for Lincoln that they have every year. We're still going to do this as in conjunction with our normal kind of kickoff meeting agenda, but it's going to be a little different this year. We're going to have the regional meeting along with a couple of other Lincoln firms in the neighborhood. So it'll be quite a bit bigger event in the morning. So we'll run it from probably 9 to 3, something like that. And then from 3 to 5 or 6, we'll have a wealth management partners meeting, and then we'll have a dinner that night with awards, and similar to what we did last year. So we'll have more details to come, but please put that date on your calendar. I was at the Wealth Forum last week. It was a very good meeting. Again, that meeting has improved significantly over the last several years. So I know it's quite a hike to get out there. Believe me, I know. But I would say well worth it. And so next year, in fact, it's going to be earlier. I don't have that date in front of me. Well, yeah, I do. It's going to be October 2nd through the 4th, so it'll be quite a bit earlier next year. But it's really it's a huge meeting now. There's almost 700 people at this meeting, quite a bit bigger than what it's been in years past. Generally speaking, I thought it was really good. One thing I wanted to mention to you, we did have a meeting with Dennis and Joanne McKelvey regarding some of the work that our advisory group has been doing with both Schwab and Pershing. I thought it was a very good meeting. We had Brian Hobbenstock was there, John Ginty was at that meeting, as well as Ryan Boyd and Jeremy Forbes. And so I don't want to get too far ahead of myself in terms of what I think is going to come out of this. But I think by next week, we should have some things to announce. Joanne and Dennis took the feedback from our advisors, and they've got some meetings with both Schwab and Pershing this week to kind of go over some of the feedback that was received, and hopefully we'll have some new services and perhaps some technology to roll out soon. So stay tuned on that. And then one thing I wanted to mention, I saw this, I've mentioned this before, I've promoted this in the past, but I just think this is one of the better documents that Lincoln produces. They call it their Market Almanac. You can find it on the website. The Q3 is out. And this is that document. It's several pages, but it's a whole lot of really good data on market review. There's a section on long-term investing, several sections, historic and current returns, value-added financial help. And I think as you're going into quarterly meetings or year-end meetings with clients, I would encourage you to look at this document. You can customize it. It'll print up. In fact, when I printed this copy that I'm staring at here, it printed up with my name and title and contact info at the bottom of the last page. You can also import your photograph, I believe, and customize this, brand it for distribution to clients. But this is a very handy thing, and especially since we're starting to see some volatility in the markets. There's lots of reasons for clients to have some concern about what's going on in the markets these days. So I would encourage everybody to take a hard look at this document and figure out how you could incorporate it into your meetings. One of the things I like about it as well is the second to the last page. There's two things there. One is it's an area called Advisor Services Provided. And this gives you an opportunity to discuss all the things that you do with clients. So a lot of the planning work that you do, I think we focus so much on the investment part of our business, and then of course the fee that is charged for that. But for many of you, there's a ton of other advice and other services you're providing that is included in that investment management fee, unless you charge a separate fee for it. But even if you do, I think giving some clarity to the things that you're getting involved in with your clients could be a huge help for you. They've got several different categories here: financial position, investment, education, protection, retirement, estate, future savings goals, small business, account services. There's a place for you to sign, a place for your client to sign. And then there's a place on the back to take notes. So again, I would take a really hard look at this document. It seems to me like it could be something that would be very, very valuable to an advisor in a client meeting. And in fact, in Shane's last weekly news, the one that went out on Monday, he references this document, and there's a place for you to click that'll take you right to it. So that's an easy way to get your hands on it. So anyway, for right now, that's about all I had. Does anybody have anything in the group that's out there to share, or questions to ask, or any issues you want to bring up before we introduce Gustavo? All right, I'm going to take that as a no. And Gustavo De La Roca is our rep for Franklin Templeton, and he and I met a few weeks ago, and this is one of our better relationships. Is Franklin Templeton. We've got, I'm almost certain they're number 2. In fact, I know they are number 2 in terms of assets with our firm, behind American funds. And there's some new services and products out there that have recently come out. But also, when Gustavo and I were talking, he had some things that, and one presentation in particular, the 6 barriers to investment success, that I thought might be really valuable for people to hear. And again, it's going back to our theme for this year, which is let's make sure that our clients understand why they're invested the way they are. Let's make sure that we're keeping them invested properly, that we are rebalancing those accounts to where they reflect the client's goals, their risk tolerance, and what they're trying to accomplish with their money. The last several years of activity in the market has driven allocations way out of whack. And as we start to see more volatility, it's going to be really important that clients be properly allocated so that they have the intestinal fortitude to make it through some of these more difficult times. So anyway, when I met with Gustavo, first of all, he's an impressive guy. He's got lots of energy and a very strong background in the industry. Really felt like he'd be a valuable person to get in front of the group. And so fortunately, we were able to make it work, and he agreed to do this. So anyway, without any further ado, I'm going to turn the presentation over to Gustavo de la Roca, and I would encourage everybody as we go through as normal, if you have questions or issues, either type in a question or hit your mute button and shout it out, and let's try to make the best of our time with Gustavo today. So, Gustavo, it's all yours now.
Terrific. Thank you very much, and definitely appreciate your warm intro. I will definitely be as enthusiastic as I was during our meeting, because I just can't seem to not be enthusiastic about what we do, and certainly life in general. To everybody on the call, I definitely want to thank you, each and every one of you, for the time you're going to be giving me today. And if you need to drop off, I do understand, but I do hope that you can hang in there. I will be brief, I will be bold, and then we'll be back to work, okay? That's my promise. And if there are 3 objectives that I do hope to accomplish during this call, first is obviously just make sure that I refresh your knowledge about Franklin Templeton, a couple of changes that we've made here. Second, I will definitely want to re-engage every one of you in this call, and really make it a homework assignment and a challenge to everyone on re-engaging your knowledge base of behavioral finance, which is what my presentation will be all about. And then lastly, just share 2 timely ideas with Franklin Templeton that will be brief. Most likely you are already aware of them, but I think bringing them to the forefront is crucially important here during this time in the marketplace. So with that said, Franklin Templeton Investments has definitely been here for quite a while. In fact, one of our flagship strategies, Franklin Income, is celebrated its 70th anniversary this year. If you think about Franklin Templeton, it really is the strength of many under the corporate banner of Franklin Templeton. We have Franklin as a money manager that deals with municipal assets, domestic equity on all sides, meaning growth or value. You've got our Templeton Group that was in acquisition back in 1992, who was really the pioneer of global investing, and today we would say it's developed investing. It's emerging market investing, it's frontier market investing. So there's quite a few of different categories within international that I think has definitely happened over the last 30 years or so. And so Templeton is our value group that handles those asset classes. And then third, Mutual Series, an acquisition that we made back in 1996, deep value investing. And so I think as I say value, please realize that value has definitely been out of favor for the last decade or so for many reasons. But I would certainly say that when you have money managers out there trying to buy $1 worth of a company, but don't pay more than 50 cents for it, I think in a market like we have right now, we got to refocus our vision here and maybe looking at some value opportunities. And so when you think about those 3 core managers, that's who I represent. We do have an alternative group called K2 Advisors under my umbrella. I do have a commodities and futures group called Pelagos under my umbrella, but those are obviously satellite positions. If anybody in this call wants to ever discuss these products with us, by all means, please reach out to me or your respective wholesaler. I did see that a few of you are from San Diego. I do hope that you are familiar with John Lundy. He is a great partner in this industry. He has north of 25 years experience, and I know that with Franklin Templeton, at least close to 2 decades. And so you've got some partners out here that want to roll up our sleeves and help you meet those client objectives. And so with meeting those client objectives, I think that if we focus the remainder of my presentation here on the PowerPoint that I'm about to show you, is we've got an environment today that if you think about it, people are looking at their statements. They're looking a little different than they did last October of 17. Definitely a little more volatility in the landscape. But people are still going to be making pretty irrational decisions if we don't get to them first. And so think about it this way, right? We have a salad or dessert, and I know that we're still far away from lunchtime, but who's going to have a salad and who's going to have dessert for lunch today? You don't need to tell me what you're going to have, but these are decisions that we make each and every day, and it's the amygdala in our brain that is going to help us make that decision. If you don't like salad, chances are you're going to have dessert or something else for lunch, and it all starts with this little gland or this part of your brain that makes those decisions. Sometimes they're rational, most cases they're irrational, especially when it comes to the marketplace. That's the amygdala gland there hiding from all of us, but it basically remembers everything. And so I would tell you that back when I was 22 years old, I had a motorcycle for a total of 6 months. I fell twice. Falling twice was enough for me to give that bike to somebody else. My brain still has that fall clearly in my mind. I could go back to it right at this moment and tell you that it was not a fun situation. And I bet that all of us on this call have at least one or two situations that we can remember that we didn't like, that we were shocked about, and it got embedded in that amygdala gland. And guess what? It will never leave. And so with that, investing is sometimes in the same scenario. I'll skip over my tiger here, but if you think about it, we're starting to see the marketplace react in this manner, right? We're having some negative days, we're having some downdraft, we're having some reallocation of capital across capital markets. Decisions are being made. I would tell everybody in this room that 3-4 months ago, the market was priced to perfection. Today, the market is realizing that not all things should be trading high, right? Earnings are definitely a lot more crucial environment today. What is the prospects of these companies surviving any sort of trade dispute between countries, political unrest, regulation that might be out there? People are finally, or investors are finally looking at these metrics that they overlooked for 9 years and are starting to be priced into the stock market. And so as we look into this presentation, it touches on 6 barriers of what we consider investment success. I'm not going to cover all of them just for the sake of not having you on the call for too long, but I'm going to cover what I consider are the most important. But before I keep going, I would like for everyone in this call to write down the name of a professor. He attended, or actually he teaches at the University of Chicago. His name is Richard. Last name is Thaler, spelled T-H-A-L-E-R. This gentleman won the economics Nobel Prize last year for proving that behavioral finance and behavior is what prevents most investors from reaching their long-term goals. He has a few books out there. If you're not a big reader, throw it in Audible, but I do give you that as an action item. To pick up a book or at least read about him because he does have quite a bit of content in this framework of behavioral finance. And not that this presentation is based on his thesis, but it's always timely to have somebody out there support our process here and support this presentation through some pretty good academic work out there. And so the 3 that I'm going to cover with you guys today is going to be availability bias. I will cover the herding mentality. I will cover loss aversion, and then skip over to home country bias. And so if you think about availability bias, it is pretty much thinking about remembering the pain, right? I use the example of my motorcycle falls and why I no longer own a motorcycle. But for most folks, it's 2008, right? It's what happened to their portfolio. The fact that they might have been overly aggressive. And so when you think about danger, not only is it in the stock market, but it's in their life. And here you have a picture of happy couples basically at the beach talking about where the danger is, right? Some people might say that it's sharks. You might get attacked by a shark. Funny enough, there are statistics that prove that people go to the beach less often during Shark Week when that's on television. But little did you know that more people get injured by the selfie stick that they're actually using here than having the prospects of a shark attacking them in the ocean. And so, again, perception versus reality, it's one of the things that we deal with. And really, perception is something that can hurt a lot of our clients and even our own mentality. And so what you're seeing here is what happened in 2008. The S&P lost 38% of its value. Yes, it was painful for those folks who were more adequately balanced. It wasn't so painful for those folks who were definitely out of whack when it comes to the risk return profile. The number could have been even worse. But what was really interesting to find is that in the next few years that Franklin Templeton did a survey of investors, of their perception of what the market had done. Even though the stock market recovered 26.5% in 2009, 2/3 of the people that we surveyed that year said the market was negative or flat. And maybe that doesn't surprise you, but I would tell you that in 2010, we did the same scenario. It was also 2/3 in 2010, in 2011, in 2012. It wasn't until 2013 that greater than 60% of the people that we surveyed thought the market was up. And so it took a few years, right? And so guess what happens? Clients lose twice. They lose once on the way down because the market goes down 37%. They make an irrational decision. And what do? What do they tell us? We're going to wait for things to get better. So that automatically means they're going to wait for things to be higher in value before they get back in. And that's a pretty painful scenario. It's hard to come back from that. And so if we can help them avoid that sort of mistake, I think that would be crucial. If you think about this chart, I'm sure we've seen it many times. The average S&P investor or equity investor has had a return of 7.68% annualized for most clients. a whopping 4.79%. You wonder why? Well, the Dalbar study that comes out every single year continues to prove that the holding period for a mutual fund has gone down from 5 years, about a decade ago, to less than 4 years today. And so when people are just giving an investment 36 months or 48 months to work, they really are cutting themselves short on long-term gains. And so big difference, right? Market versus the investor. In moving over to the herding mentality, I think we could all fall into this at some point or another, whether or not it's buying a car, whether or not it's buying a pair of shoes. In most cases in our world, it's talking about my neighbor bought Apple stock, I want to buy Apple stock. My neighbor bought Netflix, I want to buy Netflix. And all that does really is set us up for failure in most cases. And so this is an example of how susceptible we are to the herding mentality, right? And so here we have a video, quick video, candid camera. As you can tell, this video did not occur when YouTube was involved. There were no cell phones. There was still a yellow pages attached to probably a public telephone outside this building. But I think the example will be I know none of us in this call are ever going to do that in an elevator, but we do it all the time in other areas of our life. I mean, seriously, it happens. We're subject to that, right? And so these are bubbles through history where people were willing to pay 177% more for a tulip back in 1634, whether or not it was the Roaring Twenties, whether or not it was buying stocks during the dot-com era of companies that never earned a dime. It basically went out of business when they ran out of everybody else's money. Real estate, I mean, we remember there were plenty of folks that said, you're silly not to own real estate property or investment property or a flip property in Florida or somewhere else. Eventually, those bubbles can die out, right? And so it's painful and hard to come back from. So even though the manias and the bubbles can be pretty extreme, the crashes can also be very severe. And most likely, if it's a herding mentality scenario that's happening, they're going to capture more of this than the previous slide. And so let's make sure that that doesn't happen to any of our clients that are on this call. And so kind of bringing back the picture of 2002 and the financial crisis of 2008. I'm sure you've seen this before, but I wanted to remind you, as the market creeped up in 2000, 2001, there you see the asset flow in blue. Talk about the herding mentality, right? And everybody, obviously not everybody, but a whole lot of assets did leave in 2002 at a time where there was a recovery just in the making. And same situation there in 2007 through 2008. And even though this has been one of the most hated bull markets in history, it does continue to move along. There's plenty of good output out there from our economy, for our economy or global economies that are out there that could continue to have this market moving forward, but certainly not at the same pace that it's been here over the last 9 years. And so I wanted to bring this to your attention. Buying high, selling low. Let's make sure we do a very little of that. Loss aversion. In moving over to this, obviously this comes back down to the whole concept of looking at being safer in money market, being safer in CDs, being safer in your mattress. And for anybody that has ever had a client tell them that they're going to go out and buy a CD, ask them why they're doing that. My question to them is, do you know what the meaning of a CD is? They'll say certificate of deposit. I want everybody to say, no, it doesn't stand for that. It stands for can't decide what to do with my money. Because all that bank is going to do, as you know, is grab it and make it grow for them and not the owner of that CD. And so when you think about fear, dot-com bust had $491 billion going to cash. The financial crisis almost doubled at $943 billion that went into cash. And most of this, again, has taken a while to get back into the marketplace. Now, perceived safety may come at a cost. Obviously, this is looking at money market averages through 2016. The money market average hasn't moved that much here in the last year or two, but obviously after inflation, you are looking at a comfortable negative rate of return. We haven't even included taxes in this particular slide here, and as taxes have gone higher for most, I would say, again, why lock up your money earning nothing versus putting it to work, even if it means looking at timeframes. What do you need for the next 3 years? What do you need for the next 5 years? What do you need for the next 10 years and beyond? And then moving over to the last topic here of my presentation is home country bias. And certainly we all fall into this again, right? We buy companies that we're comfortable with because we see them, we see our coworkers there, we see our neighbors working there, our family, maybe we come from that region, and so we buy what we're comfortable with. We are very uncomfortable buying stocks in Europe. The headline risk is sometimes too severe for people, or Asia or Latin America. Well, this world has gotten a whole lot smaller. It's gotten a whole lot more prosperous. And if you're not looking at international investments today, you are leaving a big piece of the pie that continues to trade at very low valuations. And so the way we presented home country bias is in this manner here. So home, sweet home, right? Our Coca-Cola, let's watch some football and have our deep dish pizza from Chicago. Well, not only do we have our favorites when it comes to food and beverage, we have our favorites when it comes to stocks, and it really comes down to where we live. And so what you're seeing here in the top left is technology. The Western states tend to have a 10% allocation greater to stocks than the rest of the nation. If you move over to energy on the top right, the South, Texas, New Mexico, going into the Florida, Georgia area, a 14% greater allocation to energy stocks than the rest of the nation. Bottom right, industrials, the Rust Belt, 11% allocation greater to industrials than the rest of the nation. And of course, financials. The Northeast has a greater concentration to financial stocks. We do this each and every single day. We buy what we're comfortable with, and in order to really be balanced, in order to really be able to take advantage of the whole opportunity set, not only do we need to look beyond these regions, but we also need to look beyond our borders to get real diversification. And so in looking at how that turns out, the market capitalization of the United States is only 39% of the investable universe. So let's round up 40% of it. 60% of it is sitting outside our borders. If you go to the grocery store, do you get everything you need in 4 aisles out of 10? I don't think so. You have to go to all aisles to be able to go home and have everything you need. It's the same thing with the stock market. The U.S. retail investor today, greater than 77% of their assets are invested in just this country that are subject to one economic cycle, one interest rate cycle, one political system. Gosh darn it, we're not doing a good job if our client looks like this. And so, as I mentioned, I was going to cover those 3. There are 6 in this presentation. That concludes my presentation of our behavioral finance presentation today. But if I could leave you with a homework assignment, look at the books that are written by Richard Thaler. They will really help you become a whole lot better prepared when it comes to what's up next when it comes to our marketplace. And that is, as John mentioned, a lot more volatility, a lot more questions about why my statement isn't higher today than it was a year ago. It's been happening for 9 years. What's wrong? Are we owning the wrong stuff? The questions are going to be out there. And so be prepared for that. Let us help you. This presentation that I presented to you all today is client approved. So if you do want to partner with Franklin Templeton, we would be more than glad to have this be a client educational meeting, a seminar of sorts that we can bring to your clients. It is available and obviously approved at Lincoln. When it comes to the investment ideas that I wanted to present to you, one, John mentioned it at the beginning, and that is this here. Within your fee-based management programs, we've developed a Franklin Templeton income portfolio that is based basically on our thought leadership. We are using a variety of mutual funds per se. Not only are they Franklin, but they're also other formidable competitors of ours, including some ETF exposure. And so when you're looking at this allocation, it really just became available in the Solutions Premier program. If you don't like that particular program, just take a look at this just from the standpoint that it was really a job that was done between Franklin and Lincoln as to how we could be better prepared for those income clients as they move from accumulation to distribution. And as I look through the names of these funds, whether or not they're Franklin or Lord Abbett or Nuveen, I would tell you that there's definitely a place for these portfolios. And if you're an asset gatherer, this is definitely one solution to look at. Within your CAMS platform, I did get notified that most of our mutual funds are available on that platform. And so what I would say is this: if I can just focus on one, and obviously the fact that we're celebrating the 70th anniversary of the Franklin Income Fund, it would be remiss if I didn't mention it to you all today. This fund, for the last 70 years, has not missed a dividend payment. For the last 50 years, it has had a dividend distribution greater than 4%. For the last 4 years, where interest rates, as you all know, have gone to historical lows, it has made no change to its distribution, today paying north of 5.3% at net asset value on the A share. And so when I look at this, these are the two things I want to focus on. The first is accumulation, right? Warren Buffett said it best: the person at the end of the game with the most shares of a company wins. Well, let's translate that to Franklin Income. All we did here was look at an initial investment back in 1998, where the net asset value was 256. The account value was 100,000. They purchased 39,000 shares or so. Monthly dividend at that point in time, $598. Not a bad amount of income. But when you let this fund work as hard as you do, and that is compound, that is buy shares every month because it pays monthly. At the end of the period, even though the NAV is sitting at 229, you now have an account value of 384,000. Your share amount has gone from 39,000 to 167.8, and your monthly dividend has tripled to $1,700. That is the power of compounding. There is no better example in the industry that I know of that shows this type of income return and potential return for shareholders. And I'll tell you what, it does let you eat well and sleep well at the same time. And so this portfolio, as I said, is available on your CAMS platform. You'd be accessing the advisor share class in that portfolio. If there's any questions about it, I would love to answer any questions about that either on this call or individually on phone. But certainly, if you like what you heard, please continue to send us money. We can't keep our lights on without you guys, and we're here to help. So with that, John, I'd love to take any questions or answer anything that you might have on for me.
Gustavo, thank you for that. Folks out there, while we've got Gustavo here, anybody have any questions or comments or issues that you'd like to bring up while we've got him here?
They're busy looking for the ticker symbol. So let me tell you this. There were some changes that were made to Franklin Templeton, and this will be the last comment that I make about Franklin. And that is this: on September 10th, we made some changes to pricing. We did three things. The first is we dropped our NAV purchase price from $1 million to $500,000 for our fixed income funds, including this fund, Franklin Income. We also raised the 12B1 fee on the strategy to 25 basis points from 15 on new accounts. And we also increased the gross unit concession by 20 basis points across all breakpoints. And so there are some new ticker symbols out there. Again, if you're having a tough time finding them, please give us a call. We'd be more than glad to help in that front. But those, I think, are three changes that do help us be not only more competitive, but allow us to, I mean, I've never been able to say this in the 17 years of Franklin Templeton. We're actually giving an advisor a raise here. Normally, it's the other way around, right? And so if that helps do business with Franklin Templeton, I certainly hope that we can partner together.
Great. All right. Well, listen, Gustavo, first of all, thank you. Again, you guys are an important partner for us and for all of our advisors. It's an important component of a good deal of the portfolios that we manage. And so I guess what I would encourage everybody to do, we'll follow up with some of the information here so that you have it readily available to you. And we'll make sure that Gustavo's contact info is part of that as well. But, you know, this is I think Franklin Templeton is an important tool for us and something to consider as you're looking at your allocations to make sure that your clients are properly served. So anyway, Gustavo, thank you very much. Appreciate the time today and your interest in our firm and helping everybody with their plans with their clients. Before we hang up today, I want to remind everyone, November 14th at 10 a.m. is our next call. It looks like American Funds is going to be our presenter on that at that meeting, and we're still working on the subject matter. I got an email from them today, but we should have that by the end of the week, so we'll be sending out some reminders. And so again, if you could, 10 a.m. Pacific time on November 14th will be the next time we convene. And until then, if there's anything we can do for you, please let us know. We appreciate your business. Look forward to ending the year strong and enjoying the holidays. So again, thanks everyone for your time today, and we'll talk to you again soon.
Thank you.
Bye-bye.